The next big blockchain story might not look like a cartoon monkey, a meme coin, or a wild trading chart. It might look like a government bond, a gold bar, an invoice, or a shipment of copper. In other words, boring finance is moving on chain. And that could end up being one of the most important uses of blockchain technology. When people say an asset is going on-chain, they usually mean that ownership or transfer of that asset is being represented on a blockchain. The asset itself may still exist in the real world. The bond is still a bond. The gold is still in a vault. But the record of who owns it can be tracked using tokens and smart contracts. Real-world assets, often called RWAs, are traditional assets that are represented digitally on a blockchain. This can include government debt, private credit, real estate, commodities, money market funds, invoices, carbon credits, and more. The key idea is simple. A token is used as a digital claim, receipt, or representation of something that exists outside the blockchain. At first, this can sound unnecessary. If we already have banks, brokers, custodians, and payment systems, why put real-world assets on blockchain at all? The answer is not that every old system is broken. The answer is that many financial systems are still slow, fragmented, and expensive to coordinate across institutions, countries, and databases. Imagine 5 companies, all tracking the same asset, but each one uses its own private spreadsheet. One company updates a record, another waits for confirmation, a third checks compliance, and a fourth handles settlement. Everyone is trying to agree on the same truth, but the truth is copied across many systems. That creates delays, mistakes, and reconciliation work. A blockchain can act like a shared ledger. Instead of many separate records that need to be compared later, approved participants can look at the same record of ownership and transfer. The promise is not magic, it is coordination. If the rules are built carefully, the asset can move with fewer manual steps and clearer audit trails. A common misunderstanding is thinking the token always is the asset. For many real-world assets, the token is more like a digital wrapper. It points to legal rights, custody arrangements, and off-chain agreements. If a token represents gold, the gold must actually be stored somewhere. If a token represents a bond, the legal structure has to define what token holders own. This bridge between the blockchain and the real world is the hardest part. Blockchains can verify what happens on-chain, but they cannot automatically prove that a vault is full, a property title is valid, or a borrower will repay a loan. That is why real-world asset systems still need custodians, auditors, legal contracts, and trusted data sources. One of the clearest examples is tokenized government debt, or funds that hold government debt. The basic idea is that a traditional financial instrument can be packaged so that a token represents an interest in it. For users, the experience can feel more like holding a digital asset, while the underlying exposure remains connected to familiar financial markets. Government debt is often used in traditional finance because it is familiar, liquid, and widely understood. That makes it a natural test case for tokenization. Instead of starting with the most exotic asset possible, many builders focus on instruments that already have clear rules, established markets, and existing demand from institutions. If this kind of calm, practical explanation helps you understand where crypto and finance are really heading, consider subscribing. This channel focuses on future technology without the hype fog. Now, let's get back to the main question. What actually changes when assets like treasuries, commodities, and settlement systems move on-chain? In finance, settlement means the final exchange where ownership and payment are completed. If you buy an asset, the trade is not truly finished until the seller gets paid and you receive ownership. In traditional markets, settlement can involve several intermediaries and time delays. On-chain systems aim to make that process faster and more transparent. A powerful concept is delivery versus payment. That means the asset and the money move together, so one side does not complete without the other. Smart contracts can help coordinate this. If the buyer sends the payment token and the seller sends the asset token, The contract can complete both transfers in one linked process. Faster settlement is not only about convenience. Time creates risk. If a trade takes time to fully settle, one party may fail before the process is complete, or market conditions may change. Shorter settlement windows can reduce certain types of counterparty risk. But they also require better infrastructure, better controls, and enough liquidity at the right moment. Commodities are another major category. Think of gold, oil, wheat, or metals. A token could represent a claim on a physical commodity, a warehouse receipt, or a contract linked to that commodity. But this only works if the off-chain part is credible. Someone must verify storage, quality, insurance, and the rules for redeeming or transferring the claim. Real estate is often mentioned in RWA discussions because property is valuable but hard to divide and slow to transfer. Tokenization could make certain rights easier to manage, such as shares in a property fund or claims on rental income. But tokenizing a house does not erase property law, taxes, zoning, maintenance, or tenant issues. Some real-world asset projects focus on credit. For example, a business may need financing based on invoices, equipment, or expected cash flows. Tokens can represent claims on those loans or pools of loans. This can create new ways to connect capital with borrowers, but it also introduces credit risk, documentation risk, and the need for serious due diligence. The deeper idea is not just making a digital copy of an asset, it is making assets programmable. A token can have rules attached to it. Transfers can be limited to approved wallets. Interest or distributions can be handled automatically. Compliance checks can be built into the process. The goal is to make financial operations more efficient and less manual. Another misunderstanding is that putting assets on-chain removes regulation. In reality, serious real-world asset projects usually need more compliance, not less. They may need identity checks, investor eligibility rules, transfer restrictions, tax reporting, and legal disclosures. A public blockchain can be open, but a regulated asset may still have controlled access. Real-world assets can exist on public blockchains, private blockchains, or permissioned versions of both. Public chains offer broad access and composability, which means assets can interact with other applications. Private or permission systems may give institutions more control over privacy and compliance. The choice depends on the asset, the users, and the legal requirements. Stablecoins are often part of the story because they can act as on-chain money. If an asset token moves on-chain, but payment still happens through a slow external system, the benefits are limited. When both the asset and payment instrument are digital, settlement can become smoother. Still, stablecoins also depend on reserves, regulation, and trust in the issuer. Composability is one reason crypto people get excited about real-world assets. It means different financial applications can connect like building blocks. A tokenized asset might be used as collateral, traded on a marketplace, or included in an automated portfolio. This can create useful efficiency, but it can also spread risk if the underlying asset or rules are misunderstood. People often assume tokenization automatically makes an asset liquid. That is not true. A token can make ownership easier to transfer, but liquidity still depends on buyers, sellers, market makers, trust, legal clarity, and demand. A tokenized asset with no interested buyers is still hard to sell. Technology can improve the rails, but it cannot create demand by itself. Tokenization can make fractional ownership easier. Instead of one large investor buying an entire asset, many smaller holders could own pieces through a legal structure. This sounds simple, but the details matter. Who manages the asset? Who handles disputes? Who receives income? What happens if regulations change? The token is only one part of the full arrangement. Blockchains are good at tracking their own internal records, but real-world assets need real-world information. This is where oracles and data providers come in. They bring outside information onto the chain, such as prices, proof of reserves, or payment status. If the data is wrong, delayed, or manipulated, the smart contract can make the wrong decision very efficiently. For physical assets, custody is everything. If a token represents a barrel of oil, a bar of gold, or a warehouse receipt, someone has to hold and safeguard the real asset. Users need confidence that the token supply matches the assets backing it. Audits, attestations, and legal claims help, but they require trust in institutions outside the blockchain. Institutions are interested because tokenization could reduce back-office work, improve auditability, shorten settlement cycles, and open new distribution channels. For them, the exciting part is not always speculation. It is operational plumbing. If a process that used to require emails, manual reconciliation, and waiting periods can be simplified, that can be valuable, even if it sounds boring. Crypto users care because real-world assets can bring traditional value into on-chain ecosystems. Instead of only trading crypto-native tokens, users may gain access to assets connected to bonds, credit, commodities, or other real-world cash flows. This could make on-chain finance more useful, but it also makes the system more dependent on legal agreements and trusted intermediaries. The biggest danger is treating real-world asset tokens as if they are all the same. They are not. One token may represent direct ownership, another may represent a fund share, another may represent a debt claim, and another may only track a price. Before judging any RWA, the first question should be simple. What exactly does the token holder legally own? Real-world assets going on-chain is not about replacing the physical world with code. It is about connecting traditional assets to digital rails. The most important changes may happen quietly in settlement, custody, compliance, and reporting. That is why this topic matters. It shifts blockchain from a casino image toward a financial infrastructure question. The future of RWAs will depend on legal clarity, reliable custody, good data, secure smart contracts, and real demand from users. The winners will probably not be the projects with the loudest slogans. They will be the ones that make ownership, settlement, and compliance work better in the real world. In finance, boring can be powerful. What part of real-world assets still feels unclear to you? Is it tokenized treasuries, commodities, settlement, stablecoins, or the legal side? Leave a comment with your question, or suggest the next topic you want explained. Your comments help shape future videos, especially when the subject sounds complicated but really just needs a clearer explanation.